To know how the market is shaping up, or how can you park your investments and allocation amidst this volatile market landscape. We're now joined by Saurabh Gupta, who's the Senior Fund Manager, Equities, Bajaj Finserv AMC. Hi Saurabh, welcome to ET Now. Good afternoon to you.
Good afternoon, and thanks for inviting me to the show.
Right. So tell us, one of the major factors that is really contributing to this resilience in the market, we did see the two-day drawdown on the back of sentiment, but we have started moving up yet again. So that resilience is really aided by renewed FII interest in Indian markets. In fact, we have been seeing almost 32,400 crores worth of buying in the last 8 sessions by the FIIs. Now, given what's playing out in the US, the underperformance by US market, also the moderation in the US dollar index and the bonds, is the FII interest in India likely to sustain and provide a cushion for the markets going ahead?
Oh, absolutely. We saw $30 billion of selling. Our valuation comfort improved much better than other peer groups, emerging markets and developed markets over the last 6 months. And the way whole tariff things have shaped up, I think from a safe haven perspective, a domestic oriented story plus valuation comfort plus least impacted by tariff, all these things put together, I'm sure people who moved out in a hurry from India in terms of FPI flows towards maybe US or China are clearly looking back at India. It's a domestic oriented story. 60% of GDP is domestic, least impacted by tariff, and much better valuation, especially on the large caps. All these things put together, I think, are working in favor of allocations to India, and that's what we are doing. Quite nice buying from FPIs in Indian equities, and that is clearly supporting the markets and the resilience that you talked about.
All right. Hi, Mr. Gupta. This is Shrishti also joining in. Good to be speaking with you, but help us understand that amidst this market, which are the sectors that you are overweight on, and which are the sectors which are not giving you that much of a confidence, and you don't have much of a positive stance there?
Sure. So very clearly, we have oriented our portfolios towards more domestic consumption. I think there are multiple triggers plus valuation comfort that are lined up there. This includes discretionary and staples. So I think the portfolio allocations in terms of overweight are towards domestic consumption in the next 3-6 months, with multiple triggers like tax rebates starting to play out in people's hand from April onwards, plus a good monsoon, rural pickup. All these things put together shall support domestic consumption. So the portfolio allocation has moved towards more of domestic consumption, including banks. Banks are beneficiary of domestic economy doing well. So banks is also one of them. We are also positive on pharma, not necessarily generic US exporter, but more towards CRAMS and domestic pharma. So that's a pocket we are very positive upon. We are positive on insurance. We are clearly underweight IT or any other export-oriented businesses which gets impacted because of US slowdown. So that's one pocket we are little underweight over there. So that's the broad allocation, more tilted towards consumption, more of healthcare, but healthcare domestic oriented, or CRAMS, not US generic necessarily, and underweight IT. We are still looking at some triggers for growth in autos. So we are careful on autos, very, very selective. We are still not seeing a lot of growth, but hopefully as the economy recovers domestically, things should play back on autos, but we are still an underweight on autos, right?
Right. Sir, also talk to us about the small and the mid space. Despite the considerable correction that we have seen, do you have valuation comfort? Because there's some of them are still, some of the names are still trading at a premium, right? So how do you view that space? Because that's where, really where the wealth generation happens as far as the small and the mid caps are concerned. And investors would like to know that at this juncture, is this mid space really still at a premium, and it's a wait and watch before you actually park your funds there?
Yeah, absolutely. If you had asked me this question 6 months ago, I would clearly say that there's a lot of froth and please stay away from mid and small caps. But over the last 6 months, what we have seen is, though broad-based at a blanket level, I can always say that still valuations are are uncomfortable relative to large caps. But clearly, some pockets of comfort have started to emerge over the last 3 months in mid caps and small cap space also. So some quality names, some pockets which are valuation comfort has emerged. Those pockets, one can take a contrarian call where triggers are lined up. And we believe one has to be a bit more selective. But compared to what was maybe in September, October, situation is better in terms of valuation comfort in mid and small cap. So maybe some things can be picked up from mid and small cap space also. Not a blanket trade right now from a valuation comfort. On a blanket trade perspective, large caps are still better placed. But yes, some pockets of comfort have started to emerge in mid and small caps also for us. And that's where we are looking at. But not a blanket trade mid and small caps right now.
So it's not a blanket call on Smiths, but tell us, what are these pockets of comfort for you then?
Sure. So one should look at chemicals. I think chemicals is a space where some triggers are lined up. Valuation comfort is there. A lot of companies have completed their capex. So we believe that's one pocket one should look at. Auto anchors is also one pocket where valuation comfort has emerged. Again, a lot of capex companies have completed capex, waiting for an upcycle in demand. So people might have to wait. It can be a bit of a contrarian call, but valuation comfort has emerged, not much downside. So these two pockets clearly are emerging as very good. As I talked about CRAM space, so within CRAM space, there are some good high quality mid caps and small caps on the pharma CRAMs where one should look at. So these are clearly pockets where valuation comfort has increased. We clearly see some triggers lined up over the next 3, 6, 9 months to be invested in these companies. And of course, not to leave alone, cement. Cement is also one pocket we are very bullish, both large caps and small caps. We believe this year demand should be good. Pricing power should come back in cement. So that is also one sector, even in the small cap space, you can look at.
Mr. Gupta, we'll definitely look out for those pockets. But thank you so much for taking the time out and speaking with us and giving us a sense that, as per you, what could do well in the times ahead.
If you like this video, then like, share and subscribe to ET Now.